Summer trading is here, and with it comes what is referred to in the trading world as the summer doldrums. In short, it means markets may not be as active. But does that mean we should pause trading? Hell no! In fact, last August was one of our best trading months ever. Trading in the summertime just takes a little different kind of approach. First off, what are the summer doldrums? Well, there's an expression, sell in May and go away. In other words, close out of your stocks, go away and come back when the summer is over. Now, I don't subscribe to that. I don't believe that's the way to do it. But what they're talking about is you have very small movements and what could be some volatility, some ups and downs, directional changes, not large, but enough to maybe trigger some stops, right? So what we're looking at there is as the market slows down because people are off on vacation, kids are out of school, right? And it gets to that point, there tends to be less volume traded day in and day out. Summer doldrums can impact the performance of certain trading strategies, especially those that rely on higher volatility. But remember, lower volatility doesn't mean zero volatility. Unexpected events can still lead to significant market moves, so it's important to stay vigilant. With this in mind, there are a few different types of strategies you could choose to deploy during the summer doldrums. The first is trading credit spreads. In a period of lower volatility, options premiums often decrease. Selling spreads can allow you to collect premium, and the trade can be profitable as long as the price of the underlying asset stays within a certain price range. So when we look at that lower volatility, what does that do? It also drops down the value or the premium amount that you can receive, right? And that's happening because low vol, less fear, premium dropping. So what do? You still want to be able to take advantage of that. You still want to be able to trade that. So you want to find stocks that fit your own personal risk profile and risk tolerance. Make sure there's enough premium in that option to make it worth your while. If you would normally be looking at a $1 credit spread, 2 strikes, or 1 strike price away, let's say the 80, 81 strikes, and you're getting 30 cents for that, and now you can get 5 cents, that may not be what you want. But if you can only pick up 15 or 20 in that lower volatility, that will probably work a lot better. Another strategy to consider is a diagonal spread, also known as a poor man's covered call. So what is it? Basically, you're going to go out and buy a longer term option with the right delta, 65 to 85, and you're going to sell as short of time as possible, front week if at all possible, right, with a 40 delta. That allows me to have a closer strike price, in the money strike price as my long option, and out of the money strike price as my short option. And as long as the stock stays underneath that price that I sold, that trade expires worthless. I keep my position, which goes out a couple of months, and I do it again next week. So bottom line, when you're looking at buying options, you're going to have a lower cost with a lower volatility. You also may have smaller movements taking place. Keep your eye on what the average true range is so you know what your stock is moving in the last couple of days. No matter how you trade, it's important to note that while these strategies can provide opportunities in low volatility environments, they also come with risks. As always, make sure to consider your personal risk profile and risk tolerance, look at your financial goals and the market outlook when deciding on your summer trading strategies. With that, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Check out another one of our great trainings right here.